by now it is been clear enough, long enough, the data has been clear enough, long enough, that the general public, the media, even the most strident of the bubble burst crew is really understanding how well the housing market has held up this year, how surprisingly resilient it's been. The market was very cool last year, cooled way off. Demand slowed way down as mortgage rates spiked last year. And so the turnaround that happened really right after the first of the year, maybe even in December, was super surprising. And very few of us forecast what was going to happen. And forecasts are always tricky, but the key is that those of us watching the data right now, and those of us like on this webinar right now, are those who have been able to pay attention to the data as it was happening and communicate it so that widely enough people understand what's actually happened with housing supply and demand and prices this year. And it's funny because even the most strident of the bubble burst crew, they've sort of capitulated at this point, that if you don't pay attention to the housing data, you can understand how somebody would expect that the crisis in housing would be supply surges, people are selling, and demand craters, nobody's buying, and therefore home prices crater. And you could imagine how that would be the disaster scenario that people would imagine. It turns out that we have a different crisis emerging, and this is a supply crisis. This is a crisis where we don't have enough sellers for the number of buyers out there. Home prices are remaining stubbornly unaffordable, even as mortgage rates are in the 7s. And those payments are significantly less affordable than they were 18 months ago. We haven't seen home price corrections and very much at all. And although I'll show a few places where the local markets have corrected over the past year, but broadly across the country, home prices are not down. They're flat year over year in a world where we have significantly lower demand because things are more expensive. And so the crisis as it's changing now is really one where we're looking at a long-term scenario of tight inventory. And one of the things that I want to point out today is how different, what the difference between inventory, supply, and transaction volume. So transaction volume is both supply and demand. In some ways right now, our transaction volume is limited by the low supply. It's also limited by lower demand than during the crazy pandemic. But both of those factors are holding us down on the total number of sales. So the question is, what happens to inventory supply and what happens to transaction volume over time? And therefore, how will the market hold up this fall? So those are the things we're going to dive into today. I'm Mike Simonsen. I'm the founder president of Altos Research. And every week, Altos tracks every home for sale in the country, all the pricing, all the changes in pricing, all the supply and demand, all the changes in that data, and we make it available to you before you see it in the traditional channels. And what we're going to do right now is look at the data for July, what we know for the second half of the year, really looking about what we can know now about supply, about inventory on the market for the second half of the year, maybe for next year as well. We can look at what we know already for price trends. We can see the homes that are going to transact later in the year and where those prices are. Are they heading up from here? Are they heading down? We're going to look at some of the pending sales as well. And then, of course, we like to spend some time on the local markets. And there are some local markets and some things happening in the local markets that I want to explore today with you as we are talking. And of course, as we're doing this work, we want to spend, I try to emphasize how we communicate with buyers and sellers right now. People who might have that opinion, they might still be of an opinion that a changing economy means that home prices have cratered and that there's suddenly they can lowball offers and still get the house they wanted. We've had a surprisingly strong economy, even as the mortgage rates have climbed. And so the home buyer demand is very different than what a non-observer, casual observer might see. So those are the things we want to cover today. This webinar will be recorded. Everybody who's registered for the webinar will get the email as soon as that recording is available on our YouTube channel. You can always get it there. Again, use the chat to ask your questions. Lael and Jeff from the Altos team are in the chat always. They will have links and help to try to answer questions on the fly. And then after we wrap up, we'll stick around to try to make sure we get any of the last questions answered. And here we go. So before I dive into the data, a reminder that especially if you're new to these calls, if all of the data that I talk about today is available on the Altos Research platform, and all of the ways I talk about it are available to you as a professional to talk about the market for your buyers and sellers, your clients, investors, people who need to know about the market right now. We have a free ebook, and you can get the free ebook. There's a link in the chat to click through. If you haven't read the free ebook, How to Use the Market Data in Your Business, go grab it. It has scripts and ideas and a lot of the ways that you can look at the reports, the Altos reports, and dive in and communicate about the data. So all of the stuff that we talk about is available in your Altos account, so you can go grab that ebook, and the ebook is free. So let's start with inventory. Available inventory of single-family homes. This is the looking at the holiday week was last week, the July 4th holiday. That's typically the turning point in the market, the end of June, 1st of July. We start to see we have the best inventory with the most transactions that happen through June. And then starting in the second half of the year, the market starts to slow down again. Inventory generally, most years will climb a little bit through July and then tick down in August. The biggest thing here, so each line on this chart is a year, the curve for a year. You can see inventory starts low, it peaks in July or August and starts curving back down. Last year is the light red line, and you can see how dramatically inventory was climbing all the way through the year. You'll see in September last year, we had a second spike of mortgage rates. Mortgage rates went from like the 6s to 7 to 7.5. And late in the year, that was very surprising. Late in the year, inventory rose. And, that cooled demand way down. So any sellers that were on the market were not prepared for that. And suddenly inventory built. When we started the year, we expected this year to follow that same trend, but it did not. There were more buyers and sellers. Buyers adjusted to the current mortgage rate environment. The change wasn't a shock anymore. And so they knew what they could buy, and they continued to do their purchasing. So inventory fell, more buyers and sellers all the way through the year so far. Though we now we actually had a dip in inventory last week, 465,000 single family homes active, unsold on the market right now. Mortgage rates have been climbing in the last few weeks, so you can expect maybe in July, we'll start to see a little bit more inventory build. I don't expect it to get anywhere close to last year, but we can see exactly where the supply is. We will finish the year with fewer than homes on the market than last year. And I'll show you the forecast of inventory in just a second. This is the same inventory data in just a year, all time series, rather than each year independently. And what I like to do here is the dot on the chart there, each of these dots is this point in the year each year. You can see where each year we're almost at the peak of inventory, with the exception of the last 2 years, pandemic years. end of the pandemic in 21, and last year in 22, mortgage or inventory kept climbing all the way through the end of October. So, but normally we're at the peak of inventory. Maybe you get a few more in July and August, and then it drops off for the fall. And what that means is, as a forecast, we can see that it's really unlikely, unless mortgage rates spike 8% or over 8, then you would expect another inventory spike like last year. But if they stay at 7, the good inflation that data from this week had allowed mortgage rates to dip down a little bit. That's encouraging. And as a result, though, like that, keeping mortgage rates in the 6s will probably prevent inventory from growing much later in the year. So we can kind of already see what the rest of the year looks like. And it gets to a point, I made this point last month, but I'm going to do it again here because I think it's really valuable. There is a common misconception about how do we get more inventory? And the misconception is that when mortgage rates will fall, that'll allow more people flexibility to move and we'll see more inventory. But the data says that it actually takes higher mortgage rates to get greater inventory, to get more supply. Higher mortgage rates gets more supply, lower mortgage rates gets us less supply. So this chart's a little confusing, so let me walk you through it. The gray line is that same inventory curve since 2015. You can see that generally every year since 2015, almost every year, we've been decreasing the amount of inventory. And the reason inventory has been falling for a decade is that with low mortgage rates, holding costs for homes is cheap. And so the low mortgage rates, meaning I am going to buy my next house, it's really cheap to keep my first one, keep it as a rental, and keep it as an investment property. And as such, each year with low rates, we've kept more and more and more as investment properties. In 2018, there's a little orange section in the middle of the interest rate part of the curve there. You can see the orange section, interest rates rose through all of 2018. And January 2019, we started 2019 with greater inventory. So rates rose, holding costs are more expensive, we sell more homes. That's 2018 to 2019. Then the beginning of the pandemic, 2020 through 2021, the gray yellow line, look at it, dramatically decreasing mortgage rates. Homes got dramatically cheaper to hold. And so inventory, what happened? We hold it, we don't sell it. So mortgage rates dropped dramatically, inventory dropped dramatically. Last year, mortgage rates rose dramatically, inventory rose dramatically. So what that tells us is that while the common misconception is that it will take lower rates for more inventory, lower rates actually spurs demand, but not supply. Lower rates causes us to hold more. The holding costs are lower. The holding costs for investors, the holding costs for individuals, for people saying, I want a second home. All of these reasons, they keep our holding costs lower. And it allows us, it creates less inventory. So then long-term, how do we get more inventory? Long-term, more inventory is multiple years at higher mortgage rates, higher like in the 6s, 7s like we are now. And because right now everybody in the country has mortgage rates, you did 4%, 3% in the 2s, and those are homes that I can hold forever. But if I buy a home now, I'm buying with a 6s or 7s. And so now when I go to move, I'm selling my 6 or 7. That allows more inventory to come back on the market. Also, even if I have a cheap mortgage right now, I've got a 3%, and I have to move, or I want to move, and I buy the next house. Now, because the new payments are more expensive, I need to sell the first one for the equity. And so we reset the cost basis, the holding cost basis over several years, which will slowly get us more inventory. It took us a decade to get down to these record low levels, and it could take us multiple years of higher rates to get to the higher levels. So that's a misconception I want people to pay attention to. it's really higher rates that will get us more inventory, not lower rates. Lower rates spurs demand, but does not necessarily spur supply as much. So then let's look at inventory forecast for the rest of the year. The available inventory, this is single family homes. You can see the yearly curves are the same here. The dotted line is how we expect inventory to grow and shrink for the rest of the year. A couple things about this. One is that we are currently expecting inventory to climb a little bit in July and August, peak sometime in September. There is a forecast. We've been assuming that the economy will slow down and that will weaken demand a little bit and increase supply. At the beginning of the year, we thought it would happen much sooner in the year. So this forecast was much higher for 2023. Each week we come in with fewer homes for sale. And so the forecast gets knocked lower. So right now we're projecting to end the year with 425,000 single family homes on the market. That's like 15 to 20% fewer than we started the year. Like that's dramatically fewer than we started the year. And as of right now, there's no signal in that data unless we have a big spike in mortgage rates. And then you can see how the market reacted very quickly in September of last year. And we didn't peak in inventory until the last week of October last year. That could happen again. It could happen. You know, as I say, we don't forecast mortgage rates. I have consistently expected them to be higher than they were. And now that they're higher, I expected them to be lower than they are. So I don't forecast mortgage rates. But if they were to climb, you can see that climbing mortgage rates increases inventory. And on the other hand, if mortgage rates fall from here, falling rates are going to decrease our inventory. So you can see how that forecast would adjust through the end of the year. The fact is there is no real signal anywhere in the data of breaking out of our inventory crisis, of our supply crisis in the short term. So let's look at this from the new listings each week perspective. You can really see how we had last year at this time. You could see a big drop at July 4th holiday. Last year in May and June, there were 115,000 new listings each week. Then it dropped down under 100. And then in July last year, the new listings each week slowed way down. And that's where we are this week. We've never gotten back up to anywhere close to where we were in the past few years. The height of each bar is the total number of new listings in a given week. The light portion of the bar are what we call the immediate sales. Those immediate sales are the homes that got listed and then went into contract essentially immediately, within days or hours after listing. There were 18,000 of those immediate sales this week. The houses that are priced right are moving quickly. That's dramatically faster than we started the year. You can see how small the little light red portion is of the bar over the holidays. And then, and that's grown during the year. So when we are looking to see, we've had mortgage rates at 7 or higher really for a month now, and they dipped this week, but we'll see where they go over the next couple months. Do they recede back down? And so you can use this chart as an indicator of both the demand and the supply. When the demand is there, the immediate sales are happening. When the supply is there, when the supply is falling, we have fewer sellers, and so then the relative levels of demand, like we've had earlier in this year, was greater than the number of supply. So the key here is there's no indicator anywhere in the data of any kind of surge in inventory. There's no distressed sellers. There's no investors selling. For the most part, there's no, Airbnb bust. None of those things are anywhere in the data yet. So you would have to anticipate a dramatic, a change in the economy, like a recession. A big recession could hit still. and then for the listings to get inventory for inventory from say a job loss recession, it's really another year out after the recession hits. So we're still sort of like really strong employment. Let's say that slows through the end of the year. We start to have a job loss recession beginning of next year. It's really 2025 before those people are really selling their homes in volume. So it's at least a year, probably a year and a half before we could see any of that inventory. And then on the other hand, if rates stay lower, or if we avoid recession, then there's even less indication of any new inventory starting to come to the market. We can see the difference in market time from now and before the pandemic years and then pre-pandemic. So we'd have so currently market time is just over a month. We're at the low point of the market, right? The peak of the summer. And then last year, market time had already started climbing because mortgage rates had climbed, demand had already slowed. So the market slowed much more abruptly last year than it had recently, and than it has this year. But you can see in market time, how long the house is on the market. You can see that is a function of less demand than we had during the pandemic, but not cratering demand, right? So it's really a view, and you can obviously see this, and I'll show you when we dive into the local markets. I'll show you how price ranges matter on the on days on market time, and we can really see where people are buying homes. Let's look at pendings. So these are the homes in contract and the new contracts each week. Each bar here, the height of each bar, the total number of homes in contract, single family homes at any given time. Last year, you could see during the pandemic when we had big buying frenzy at the time in 22, 21, we had more homes in contract than were on the market. We had way dramatic demand indicator. More people buying homes so quickly. There were more homes in contract at any given time than were actually available to purchase. Last year, that second week of July, right after the holiday, you can see a dip right in the middle of the chart. You can see a big dip in the total pendings. We were at 420,000 pendings last year. The number of pendings fell quickly during the year, during the second half of the year to very low levels, right? Everybody felt it in the fourth quarter. We could see in the middle here in September, there was a next jump in mortgage rates, and you can see immediately the number of sales dropping. So this year we are past the seasonal peak of home sales, which is really in June, and slowly ticking down. There were good new pendings this week, and so keeping that elevated. And what that tells us is that right now we are 9% fewer homes in contract than when we started, than last year at this time. We started the year at 35% fewer homes in contract than a year before. And that's the sales volume that everybody felt. So we can see some real stability in the number of purchases. It's not a ton, right? We're not back to frenzy time of the pandemic where people are buying everything in sight. But you can see that actually by the end of the year, we might actually be positive year over year. More home sales at the end of 23 than the end of 22, right? You can see that because 22 cratered so dramatically. And again, especially if rates don't spike from here. If they do, you can see that curve again. Like the consumers are very sensitive to the mortgage rates. And so if rates jump from 6.9 to 7.9, that's going to slow sales, and you're going to see it in the new pendings each week. If I'm shopping and rates dip during the week, I make the offer. If they spike during the week, I'm much more likely to wait and see if they dip again. And so you can see the new pendings number react very quickly to mortgage rates. They did in July and they did again in September last year. Let's switch to pricing. The median price of single-family homes in the US right now, if you walk into the market and look at all the homes, it's $452,490. That ticked down a little bit. It's July, we're past the peak. So that's the dark red line here. And last year at this time, we're peaked a little bit higher. So we didn't quite get back to the year over year. We were under the price from last year. But last year, you could see the dark red line was dropping every week very quickly. That was the demand adjusting. Sellers were seeing that they're not going to get their offers and they were adjusting their prices. Any new listings were coming in very quickly lower. That is likely to dip much more slowly this year. We have the support. We have some signs of cooling at around 7%. So like I said, consumers are quite sensitive to that. It's not a slam dunk. If rates jump, you'll see that dip also. But what we can see is that we'll probably in July, August, we'll probably start showing positive year-over-year price changes. And I don't know anybody who was really expecting positive home price changes in 2023. There were some really smart forecasters who were expecting 20% price decrease, like year-over-year home price cuts in 2023. And it just never materialized. We were expecting, for what it's worth, about last year at this time, we were talking about, we could see inventory had climbed. We could see that, we know that climbing year inventory generally leads to flat or declining prices the following year. Declining inventory leads to increasing prices the following year. So last year at this time was where we were really saying, it looks like 2023 is going to be flat at best, flat to down a little bit. And right now it looks like we're going to end the year flat to up a little bit, just a little bit. And because we're going to end 2023 with less inventory than 2024, than 24 has positive signals for home price gains already baked into the data now. So because inventory is starting to restrict again, that indicates that's like a reasonably correlated with home price gains in another year out in the future. So the signals we can already see are that the home prices will largely hold up transactions for the rest of the year, and the prices the signals now for 24 are slightly positive. I say that I'm always nervous saying that, because like I've been worried about an oncoming recession for 18 months now. It hasn't happened. And so we are outperforming. If a big recession hits, like that, then we start trying to work that into the data. But the housing market has really outperformed all the expectations. The light colored line here is the median price of the new listings. Each week, the cohort of homes that get listed. And it's a really great leading indicator, because it's what the economists call the wisdom of the crowds. And the crowds are the sellers and the listing agents who, in general, like, exactly where to list a house to get it to sell. And so in the crowd, in the aggregate, those homes get listed exactly where they need to. And when you see that nobody bid on the one down the street, there was nobody at the open home, and you have a house to list, you list it at a little discount. And when you list it at the little discount, now that light red line starts to dip. Last year, the light red line was dipping very quickly in the second half of the year. That's because anybody who was listing in August, September last year, they knew demand is super weak. We got to take a discount to get this thing to move. And so you could see it very quickly in the light red line. The median price of the new listings this week is 400,000. That's a little bit there's a dip in the holiday week always. That'll probably jump back up a little bit next week. And it'll be interesting to see if that's positive year over year starting next week, showing our home price gains. So the homes get listed now. They take offers in August, that closes in September or October, and that starts to get reported in November. And so what we can see is that we're probably going to see, the headline home sales numbers in October and November, they're going to be positive year over year. And it'll be like surprising for some people, although most people, thanks to like our community here, are aware of what really is happening in the data much more quickly these days. And so it's our job to keep communicating that so that they're not surprised. And for example, if you have a buyer that's on the fence now and waiting for home prices to dip, the fact that there's no signals in the market of home prices dipping is like a real message. There's no signal of huge home price gains in the future, but if they're sitting there going, nope, I'm waiting for the crash to happen, the question is, how long do you want to wait? Because there's no signal anywhere in the data right now about prices crashing. And let's look at that new listings price in a yearly basis. So you can see the dark red line is the price of the new listings each week. And you can see how for several months we've been below last year, the dark red line below the light red line. Tick down this week. And next week, it'll be really interesting to see if we don't get an uptick and we're priced above last year, the new listings priced above last year. It's going to be pretty tight all the way through. If rates don't spike like they did in September of last year, then you can imagine that the curve in the light red line curved down pretty dramatically in the second half of last year. And so you could imagine us finishing stronger than that and therefore ending with a little bit of a year over year gains. We could see that in, remember I was mentioned how 2019 had inventory increases over 2018 due to those increased mortgage rates. And that a year out past that then is when mortgage rates are flat year over year, or when home prices are flat year over year. So the yellow line here, 2020, you can see it bounced along just before the pandemic, right about the same price level as the year before, because we had inventory rising. Like we could see that in the data in 2019. Then of course, pandemic happened, rates dropped dramatically, and the rest of the year of that yellow line finished super strong for 2020. And then the pandemic is built in there. Let's switch to the pendings though. So now we're looking at the price of the homes in contract. And what do we know there? Well, it turns out the home sales prices, the ones that are in contract, are already priced above last year. They've been below last year. Here's two years. The dark red line is this, and the light red line is last year. And so the pendings, when we look at all the homes in pendings, this is the asking price of the pending. So it's not the final negotiated price, but they're in aggregate, they're pretty close. The price of the pendings has been below last year, but last year the prices corrected in July and again in September. And so our year-over-year comparisons are starting to be strong, easy. And so we can see that the last few weeks, now home prices are above last year. And my expectation is that we'll go contract prices tick down in the second half of the year. So it'll tick down, the red line will get closer to stay closer and just above the light red line of last year. And we'll finish the year up, flat to up, maybe a couple percent is the way the trends look right now in home prices. So these are the ones that are in contract now. They'll close in July and August, and those will get announced in August, September, October is how that works. But now check this out. These are the newly in contract. So in a given week, which ones went into contract? So now all the homes in contract have some that have been in there for 4 months and things that take a long time. But just looking at the ones that went into contract this week, look how strong this price signal is. So the light red line, you could see June 22 prices dipped, September prices dipped dramatically. And we haven't seen that yet this year. We haven't seen anything like that this year. So now suddenly we've had like 5 weeks in a row with the homes that are going into contract are priced above last year. These are transactions that are going to close in the future, but they'll start working through. And so that shows us how the homes that are in contract the previous slide is going to stay strong. There's nothing in the homes that the prices that dropped dramatically in the last month or so. Now, as we, in the last month, mortgage rates have climbed to 7% or higher. This week was a little dip back down with good inflation news, but if rates go from 7.5, they stay there, you could see how that affordability change would bring our new contract ones down. And what we can see right now is that buyers are generally, while we could see a few fewer transactions, we can see that there are buyers at homes at these prices, at these mortgage rates right now. This is a leading indicator for future sales prices, and it looks pretty strong. So now then we'll finish up here with price reductions, and then we'll swap over to the Altos platform. We'll look at some of the local markets, and we'll dive in there. The percentage of homes with price reductions is a leading indicator of future transactions that we like to talk about in these videos. There are currently 32.5% of the homes on the market, single family homes on the market, have taken a price cut. That's a totally normal range. And the way it works is this: there are about a third of homes, 30%, 35% of homes take a price cut before they sell. That is, some of that's intentional, right? Some of that's a strategic decision from a seller who says, I want to overprice. I'll do one price cut, and then I'll know exactly I got the most for my home. Sometimes it's accidental. Sometimes it's fishing. Whatever the reason is, about a third take a price cut before they sell. And during the pandemic, you can see 20, 21, 22, we had way more demand than we had supply. And so a lot of those fishing sellers got their offer. They didn't have to take a price cut. Things were moving so quickly and they were overbidding that we didn't have as many price cuts. So we had record few price cuts. And then as soon as mortgage rates jumped last March, you could immediately see slightly fewer offers, slightly more price reductions. So the light red line deviates from the tan line. And you could see by this time last year, it was like going from 32% to 33.5% to 35% in a week, right? There were just people cutting prices left and right. They were stuck on the market from, they tried to list in May and they didn't realize they had missed the window. And we talked about it in these webinars last year. Like, there were sellers in June last year and who were going to be surprised that they'd overpriced, because we could see it, the demand changing on the nose. We can also see in the chart from last year that spike in September. So now September, the light red line starts going again. That's that mortgage rate moment. And so we can see the demand change immediately in those days. In the last few days, the last few weeks, so 5-6 weeks of mortgage rates at or over 7%, we could see slight increases in the price cuts. We could see slight increases in the price cuts, and that's like people delaying offers. And if I don't get that offer, I am more tempted to do a price cut. And so we'll see the demand impact there. And again, and I've said this a few times, but this is really how the rest of the year is going to play out. We can watch in the data here. If we see a rate jump, we can see exactly when the price cuts are going to hit. If we see rates drift lower, that dark red line is going to come in under 2018, 2019, under last year, and really only have more price cuts than the peak of the pandemic time. Meaning, like, it's going to be super rare to get back to that crazy pandemic demand surge where we were buying everything. And so these record low rates where there's 15% of the homes on the market with price cuts, or even this time of year with 22%, is really unusual. And so we're in this normal range. We're going to finish in the normal range. Whether we finish above 2018 or below will be a function of where rates settle in and how much demand we spur. And by the way, I go back to that original comment I was talking about, where higher mortgage rates for more inventory, lower mortgage rates for less inventory, not the other way around. Lower mortgage rates, and you can see it. You can see here, higher mortgage rates means I'm cutting demand, and therefore I got to cut prices so we could try to spur demand. Lower rates, from 19 to 20 to 21 to 22. That's when we were just driving demand. And we weren't driving supply, because at that cheap level, it's really cheap to hold the homes. So that's the mix that we are seeing, and that's how it plays out there. Let's switch over and let's dive into some of the local data. The first thing we'll do is, this is the Altos Research platform. I am logged into my account, which is a national account. I have data for all over the country. There are all our typical accounts for realtors and loan officers and title folks have local reports. And you can see where I have people reading the reports from around the country. And we have the contacts that are getting those reports, the email campaigns, they're sending them. We can see that how many people are reading Mike's reports every week. But let's look at the advanced analytics platform. In the Altos Advanced Analytics platform, this is where you can go create what if scenarios and comparisons. And so at our so if you're a subscriber, you can get the advanced analytics platform and build these yourself. What I like to do is, we were talking about price reductions, and what I want to know is the rank, who's got the most price reductions and who has the fewest price reductions. The most price reductions means relative demand levels are weakest relative to supply. And so, and are they climbing? So in the chart here, these are little spark lines, and this is 3 years of the price reductions data. Austin has been leading the country in price reductions all year. And what's interesting is Austin, I've got to actually have a few local reports for the Texas markets, because in some ways a couple of these, Austin and San Antonio, for example, might be the weakest markets in the country right now. And that may be a migration pattern thing. In Texas, we tend to see more commonly price reductions than in a place like California, for example. California has chronically low shortage of inventory, because California's property taxes are so low that that means it's really cheap to hold. It's a really good deal to hold and not sell. Where in Texas, they tend to have high property taxes, which means it's more expensive to hold. So you get more resale, you get more inventory per capita, per people, and therefore you see more things like price cuts. But what we can see right now is, you can see how dramatically Austin went from just 11% of the market with price reductions about 15 months ago, to 60, 61, 62% had cut their prices by the fall. We're in the 50% range right now. And that really shows us weakness compared to many of the markets around the country. And you can see San Antonio here too. I've been talking about this year how the Florida markets have actually been dominating the price reductions this year. This month we're starting to see some other places in the country. Denver's climbing up a little bit. We've got New Orleans and Indianapolis that are climbing up a little bit. So the Florida markets are not dominating as much as they were earlier this spring, which I think is interesting. But I think really the story this month to go look at are these couple of Texas markets. What I also want to show though is down at the other end, where are the places where we have fewer price reductions? And you can see some of the places are, this is Raleigh and Atlanta, Cincinnati. The Midwest and Northeast markets have actually been performing significantly better, more resilient, lower inventory than the Western US markets all year. And so I've got a couple of those up, and then we will take a look at what those look like. Okay, so here's Austin. Here's a market report for Austin. Again, this is mine. It's branded for Altos Research. When you are a subscriber for Altos, these are branded for you to get to your clients. I have this one at the metro level to look. But of course, Altos covers every zip code in the country. And so you can go dive into your local markets for your clients right now. Let's start with Austin and look at the price changes and where we are with home prices versus last year. This shows us the median ask price. Home prices recovered a little bit this year, but never quite got back to the peak of the frenzy of last year. So last year was California buyers coming in, buying site, overbidding. There was a lot of momentum through April, and then it turned the corner starting in April. Prices were adjusting very dramatically already last year, just a little bit slower this year. My suspicion is that a year out in the future, Austin doesn't have signals of prices declining further from here, but they haven't gotten back to the peak of the frenzy. And that's a notable thing because most of the country has. You can look in the price range quartiles. We can see that it is, things under 500,000 or really under 400,000 are moving more quickly. Days on market at 42 rather than 2 months or more in the $1 million range. So you can see where demand has happened. Let's also look at San Antonio and then compare it to Dallas. So in San Antonio, this is the Metro San Antonio market. We can also see that prices started falling down last year, peaked in June, and were correcting pretty quickly. We could see that they never quite got back to the peak of the frenzy last year, but aren't falling dramatically here either. So Austin and San Antonio are really interesting that way. We can see price reductions in San Antonio. We're in the 40s. In fact, let's look at the big chart here for price decreases. And we can see how we have more price reductions now than pre-pandemic, right? It's softer now than pre-pandemic. We could see the change in price reductions last year, meaning the brakes were on. They were slammed last year at this time. And I think this is really maybe sensitivity to affordability in San Antonio. The buyers in San Antonio tend to be lower income buyers they're going to San Antonio because the homes are more affordable. But that affordability, you can see the last few weeks, price reductions kicking in because as the last few weeks, as mortgage rates are at 7, like I'm going to wait and not buy in San Antonio. So much more sensitive to rates than, for example, Dallas looks to be. So Dallas is, it's interesting because, it's still Texas, but a much different, much more diverse metro market. You can see that home prices are basically maybe a tad below where they were last year. They dropped really quickly second half of last year, and they're going to drop less quickly. So we'll end with price increases year over year in Dallas this year. You can also see that the time on market in Dallas is faster at all price ranges, right? So that's a much more, and you can see in the market action index, because inventory is so tight. In fact, let's look at inventory compared to pre-pandemic times, right? Inventory is still 13,000 versus 20, 21,000, 25,000 before the pandemic, like half as many homes on the market in Dallas. And buyers know it. It's still a growing market, but there's half as many sellers. So you can see why the home prices have held up. You can see why it says strong sellers market there. And we can also check how the price decreases are right in scale here for Dallas, right in the normal range for pre-pandemic. About 40% for Dallas is normal, where in some of the hot California markets, normal might be closer to 20% with price reductions. All right, so let's look at one of the California markets. Sacramento, I like to say, Ryan Lundquist is an appraiser who does really great housing market data. He does it on Twitter and Threads now and LinkedIn and stuff. And what he does is all the Sacramento data. And what I like to say, Sacramento market is like the whole US, only more so. It's like the same trends, but more than the rest of the country. So here's prices in Sacramento. Sacramento is home prices are up. You can see up year over year in Sacramento. You can see that the demand at the low end in Sacramento, under 500K, there's still 14 days. Like, these are getting multiple offers. They're going immediate sales. There's a lot of activity. And even anything under $1 million is still under a month. And the $1.5 million is still very fast in Sacramento as well. We can look at price decreases in Sacramento. And so, last year, Sacramento slowed, the whole country slowed. Sacramento slowed more so. This year, the whole country improved. Sacramento improved more so. And then in the last few weeks, you can see each year, Sacramento's price reductions kick up. They're about halfway to the peak normally. So we've got more, the market will slow down in the fall. It is still with fewer price reductions than normal pre-pandemic times for Sacramento. So you can see that there is actually still a stronger market there than there is in the rest of the country. It's like a proxy for the rest of the country, except it feels like more so. I mentioned that the Midwest and the Northeast markets were moving faster than the rest of the country. And here's Cleveland. And here's the available inventory of single-family homes on the market in the Cleveland metro. Cleveland is lower than the pandemic crisis. Fewer homes on the market now than during the pandemic. The year we had finished, in March with slightly more, but this time of the year, nothing's growing here. So Cleveland there is really no weakness signals, but the hard part is it's a supply constrained market. We can see that, let me get price decreases here. We can see that the percentage of homes with price decreases is right in the space. It is not pandemic. It's fewer than normal. It's because the relative levels of demand are there for Cleveland. That bodes well for home prices to hold up in the future. Again, Cleveland is an affordable market, and it'll be interesting to see how, if those affordable markets are more or less impacted, like San Antonio, by rising mortgage rates at the sevens. But in general, the other interesting thing about Cleveland is that you can see the demand in Cleveland is actually in the middle of the market, where the two high end and low end is much slower because of the stock. Like the low end, these are 100-year-old 3-1s, like these are significantly less desirable homes. But once you start to get to 2-bathroom, 3-bathroom is where the people want to buy in Cleveland. And that makes a lot of sense. So you had 75K, there's a lot of, those are old kind of junky places that are very specific types of buyers for those. Let's review, we're coming up on time. Let me wrap there, and then we can send it back to the let's wrap with the data. Is all of the stuff that we've been talking about here, that I talk about, it can be in our ebook, our free ebook, how to talk about the data, how to use market data in your business. If I didn't get to your local market this week, I can't get to all of them. People ask me if we can, and the answer is yes, we can, of course. So go to altosresearch.com, book a free consult with our team. Jeff and Lael are in the chat. They can provide links. You can go click through on where to go. Just book time with us. When you book that time, we can look at your local market. We can talk about how you use the market data in your business. We got tons of examples of people doing it really well. We had a great call this week, an email that came in from a home buyer who said, your data really helped me understand whether to make a decision. I bought my home because I understood from the Altos data, and they were getting the data directly from us, but they should be, those home buyers should be getting the data from you and help them make the decision, help them get off the fence, because people generally don't know what's happening in the housing market and they need you to be the expert. So go to Altos, book time with our team. Thank you so much, as always, for your attention. I really appreciate it. And back more next month. Thanks, everybody.